So all this while, we have constantly been touting that Alibaba or the entire basket of Chinese equities are extremely undervalued, or some might even argue deep value. However, no one seemed to have entertained the idea that what if they are currently overvalued based on projections and how the company is performing in the subsequent few quarters. So let's entertain this Seeking Alpha article. Is Alibaba overvalued after generating 30% this year? Let the fundamentals do the talking. So based on the time this article was published, the price of Alibaba was $111 then. So since then, it is already down 6.28%. So does it really mean that Alibaba is overvalued? Let's take a look at his entire discussion. And before I forget, Seeking Alpha actually prompted me via an email thread to notify you guys of the special offer that they're currently running with their Seeking Alpha Premium Annual Plan. So currently, they'll be on sale and available for $99 for the first year instead of the $239 price tag. That's a 59% discount. So in addition, your audience will be able to try Seeking Alpha Premium for free for 7 days. So for those of you who just want to try it out, I think this is a risk-free way into understanding what are the premium features and the premium articles that Seeking Alpha has to offer. So that's that. If not, let's get right into this idea of whether Alibaba is overvalued after this recent crazy run. So in summary, the core commerce segment looks strong with strong demand from the Lunar New Year. So the international commerce segment continued to be supported by Alibaba Group. The cloud computing segment continues to prove it's the leader in multiple categories. So the author's sum of the parts target price for Alibaba is 143, implying around a 31% upside from current levels. So of course, based on this preamble, we probably can speculate that the author is probably still pretty bullish about Alibaba as a company and probably as an investment. So let's look specifically and let's try to dissect down the investment thesis. So my core investment thesis for Alibaba remains the same. The only change has been the progress the company has made since my last article and the changes in the regulatory and political landscape. So I think that Alibaba looks attractive on a risk-reward perspective despite having generated 30% returns on a year-to-date basis, as it has come from a low base and valuations still remain cheap. So my core investment thesis for Alibaba is elaborated below. Firstly, Alibaba is one of the key beneficiaries of the China's economy opening up as COVID restrictions are removed. Secondly, the company has progressed well with its cost optimization efforts. Thirdly and lastly, the cloud computing segment continues to improve and lead the industry, and I expect greater momentum in 2023 as China reopens and the Chinese economy reopens. So let's target the pointers one by one. So first and foremost, I do agree that Alibaba will be the key beneficiary of the Chinese economy reopening. And this thesis itself has been touted by many of the investment banks. So if my memory serves me right, it was Credit Suisse that said that Alibaba was their top pick for 2023 to essentially bet on this China recovery story. But I fundamentally believe that whenever these sort of analyst reports actually reach the hands of retail investors like you and me, when I can make a video on it, it's probably a little bit too late. Many of the buyings by all the hedge funds and by all these bulge bracket banks are probably done a few months back, which is in Q4 of last year, which also explains why super investors like Michael Burry has already entered his positions in Q4 of last year. So when they release their news or even their bullish thesis on a specific sector, a specific industry, I mean, it's probably too late for you to enter. So that's that. Just a precaution to keep in mind. Secondly, I think in terms of the cost optimization efforts, I do echo similar sentiments as what the author has suggested. So I think just to quickly pull out some of the numbers that Alibaba has been driving at for at least the last few quarters, we know that in 2021, it hasn't been a very good picture for Alibaba. Just looking at their operating margins, so just take a closer look at my cursor because I know it's pretty messy. So in Q1 of 2021, which is the June quarter, the operating margin was around 15%, and then it started collapsing downwards to 7.5%, 2.9%, and then back up to 8.2%. So these are pretty lackluster numbers considering that they are a tech company. But I think based on the 2022 quarters, it does seem like there's some sort of normalizing upwards to at least mid double digits, and let's look forward to how it performs in the following 2 quarters as well. So I do agree that the cost optimization efforts are slowly showing numbers, but let's not forget that numbers tend to be backward looking. Now, thirdly and lastly, the cloud computing segment continues to improve and lead the industry. I think numbers don't lie. At least for now, Ali Cloud do seem to continue to hold a very strong foothold in the entire cloud business. But that's not something that should be taken for granted for, because it does seem like many of the other competitors in the space itself are also on Alibaba's back, and Alibaba is slowly losing market share in the Ali Cloud business. So that's a KIV, and you should take into account that in your own analysis subsequently. According to Sina News, the national online retail sales for the first 5 days of this year's 2023 National Online New Year's Shopping Festival actually reached around 208 billion renminbi. So this was 5% up from the same period in the prior year. So in particular, it was stated that growth was particularly strong for new consumption models like live streaming and on-demand delivery. So I think there's two parts here. Showing a growth year on year, of course, 5%, 8%, 10%, or even a 2% growth year on year, it's probably good. But let's not forget that there was a low base effect comparison here, because in 2022, it wasn't a very pretty year for China specifically. And more importantly, this idea of Lunar New Year reopening and the entire festive season causing more people to spend, it might be a temporary effect. So in order for you to really drive home this point on whether core commerce fundamentals are improving, you need to continue monitor out into the subsequent few quarters, and not just because, oh, it's the Lunar New Year, COVID restrictions were lifted, people were traveling all over the place, and this spike up might just be a temporary one because of the festive seasons. But I think that's just some perspective to keep in mind. On top of that, there's also an improvement in supply of pandemic products, and also Hema, which is their grocery brand, actually turned profitable. On top of that, their international commerce is slowly gaining traction as well. So as the author suggested, there is continuous capital injection into Lazada from Alibaba. And for those of you who don't know, Lazada is essentially the international commerce arm of Alibaba, and it operates primarily in the Southeast Asia of this region. So it does seem like the author is trying to paint a relatively rosy picture for Lazada, saying that Lazada Philippines had a successful 12/12 campaign, there was a 44x increase in gift cards, there was a 17x increase in new buyers, and even Lazada Singapore, which is the country I'm in, partners with SingPost for deliveries. I would just like to say that many of these numbers are pretty cherry-picked. At least as far as I'm concerned as a consumer, looking at the entire in battle between Lazada and Shopee, it's still neck and neck. Just because there's a capital injection doesn't mean that Lazada automatically wins Shopee. I think Shopee is still putting up a very strong fight, and I would commend C Limited for that. But I think just looking at the industry specifically, it does seem like demand is slowly dwindling down, and competitive pressures is still strong in this side of the globe. So I wouldn't read too much into this investment into Lazada and how all these numbers might seem spectacular at face value. So if you want to convince me that the international commerce arm of Alibaba is gonna be something big in the future, show me in the earnings report and not all these numbers. So that's just my own baseline. Now, I think this is the most important part that we all look forward to, especially for many Alibaba investors, which is the cloud computing business. So there's recently an organizational change where Mr. Jianfeng Zhang, he will step down from the president of Alibaba Cloud Intelligence, and Mr. Daniel Zhang, who's the CEO, will actually take over. And this essentially signals some sort of key leadership changes. And Daniel Zhang did emphasize that the keyword for 2023 is progress, and that the organizational change is the first step to progress. So I'm not too sure what's Daniel Zhang's background in terms of how he's going to deliver growth and deliver the differentiation factor in the entire Ali Cloud business. But I look forward to what he can produce. And I think looking back, Ali Cloud's growth rate has been subpar, and subpar is actually an understatement. If you look back all the way to 2019, I think just looking at the cloud segment, look at it. Look at this, follow my cursor, yeah? 66%, 63%, 62%, 58%. And then it starts collapsing down. 58%, 60%, 50%. So this was still good in 2020. And then in 2022, the cloud segment, 10.18%. And then the previous quarter, 3.7%. So I think it was pretty much a disappointment, but all things considered, I think given the entire slowdown of the economy, there was a lot of pullback in terms of budget. So let's look forward to whether this entire reopening story of China in 2023 is really as good as they say, or is it just a fairy tale? So assuming that everything goes back on track and everything goes back to the norm, I would presume that the cloud growth rate will probably recover again, but let's see. Now, moving on to the valuation metric that he used to derive the valuation of Alibaba. Number one, for the China e-commerce segment, I have the view that we will see the segment return to growth on the back of relaxation of COVID restrictions in China. Second, for local services, Cainiao and other investments and associates held by the company, these segments are valued based on their latest transaction values and market cap of the respective company. And lastly, for Youku, international commerce and cloud, I value these segments using DCF, taking into account the long-term growth opportunities for international commerce segment. And if you were to put together everything, after applying a 30% holding discount, the sum of the parts target price for Alibaba is 143. So let's look at each of the individual component. So judging from how he does the numbers, this is just a screenshot, so you can't really pinpoint the exact formula that he used. But just looking at it generally, I think for Cai Niao and local services, $7 per share. So the data was probably from a last transaction record from somewhere. And the local services arm, he probably cross-checked it with Meituan and probably using a 3.5 times price to sales. But let's look into the DCF figures specifically. So for China Commerce, he applied an implied PE of 15 times, and International Commerce, he applied a 30 times implied PE. And for Cloud, based on his DCF, I don't know what's his assumption, he came out to around $30 per share. So firstly, I think for China Commerce, using an implied PE of 15, I don't think it's too much of an ask, it's pretty fair. But for International Commerce, 30 times might be a little bit too steep, especially when International Commerce haven't been growing very steadily. On top of that, competitors have been slowly eating the lunch of Alibaba's International Commerce business. So for this 30 times, or at least this $15 USD per share, just keep that at the back of your mind. Just be skeptical of this number. But specifically for Cloud, I think individual investors have to come up with their own valuation, because some people might have huge expectations for the Cloud business, but it's probably somewhere in between. So if to provide a range, I think the USD per share is probably around 50 to 30 dollars per share. And I'm just going to write off this Yoku because I don't think it's a useful business anyway. Now, in terms of the associates and the investments, I think this includes Ant Group. So in terms of the market cap and last transaction, there's not much to argue here. And similarly for net cash, $26 per share, not much to argue here. So if to combine everything, actually the total is around 204. But he did apply a 30% holdings discount. So I would probably, my first question would be, why apply a 30%? Why not 40%? Why not 25%? I can tell you that probably most of these numbers was pulled out from the author's ass. And similarly, in my own projection, I also pulled out a lot of numbers from my own ass. But you honestly just have to be comfortable with the valuation work that you have done thus far, and just have some sort of substantiation on why you chose this number. Could be because of a margin of safety, could be because of past case studies, etc., etc. But just be clear that this is his own valuation model and this is his number. So don't take everything as gospel truth, and you probably want to come up with your own model as well. And I think last but not least, he did kind of provide some sort of a balanced argument here, but the risk is very much watered down because he didn't really go in depth to it. I'm talking about competition, regulatory and political risk, cloud risk. But I think to circle back to his bullish thesis, I'm largely in agreement, but I think you might want to be more cautious about this festival effect, and more importantly, let the numbers do the talking. So I look forward to this entire cloud business regaining control and regaining growth. Last but not least, I think I just wanted to react to this very peculiar or very interesting comment that is in the thread itself. So from DDD value, using Chinese CDC's own COVID death rate and 80% infection rate, the figure is around more than 1 million deaths. But the official COVID deaths count from China is 70,000. So this is called Marxist nationalist propaganda. The scary part is that sometimes the CCP elites start believing in their own propaganda, and when this happens, mistakes also happens. So this has huge geopolitical implications. All Chinese neighbors are increasing defense spend and forming military alliance to deter Chinese aggression. So they obviously don't want to be on the receiving end of the CCP mistake. So if I were a CCP capitalist, I'd pack my bags and leave China. It's just all these lies and propaganda from a totalitarian government that no one can question, and an ideology that doesn't work and fundamentally anti-capitalist. So this whole discussion of Alibaba, look, the author spent so much time to write so much, and then this guy just comes in with a anti-system, anti-China, anti-CCP kind of thesis, and he basically outright just cancels everything because regardless of how cheap the company is or regardless of the valuation, there's no price too low to enter. So that's at least my own perspective of how he's framing his argument. But I think I would just like to say this, since I highlighted this part, right? If I were a Chinese capitalist, I'd pack my bags and leave China. So let's look at the stock exchange value of the Chinese market itself. So I think one of the hallmarks of a capitalistic system is the ability for the private and public fund to raise money in this public market where it's probably aggregated on the stock market. So let's take a look. Just to draw some context and draw some comparison, these figures are based on December 2022. So it's relatively updated. So the New York Stock Exchange has a market cap of around $28.8 trillion. And the market cap of the Nasdaq has around $27.79 billion. So let's just sum both of them up. 28.8 trillion. Okay, let's just ignore Nasdaq because billion and trillion, it's of a different level. Shanghai, 7 trillion. Shenzhen, 4.5 trillion. Hong Kong, 4.5 trillion. So if you do some quick math, 4.5, that's 9 trillion, plus 7 trillion, that's around 16 trillion. 16 trillion compared to around 30 trillion from the US market, that's probably half or more than half. I think around 55% of the US market. And you say that if you're a Chinese capitalist, you pack your bags and leave China. Sure, please do yourself the favor and leave China. So I still believe that there's a lot of money out there that wants to invest in China. And evidently, numbers don't lie. So I do think that there is still a great deal of interest, but maybe now's not the time. Whether in the next 5 years, 10 years, would we revert back to the mean and go back to decent amount of valuations rather than the Hang Seng Index trading at like what, 7, 8, 9 times earnings? I don't know, but I'm putting my money where my mouth is at, which is why I continue to stay invested. With that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye.